After studying this module, you will be able to focus on the norms used by the banks for financing working capital requirements, identify various study groups on bank credit for financing of firms' working capital needs, elaborate the objectives and recommendations of various study groups.
As we know, Reserve Bank of India regulates banks with the respect to short-term bank credit to ensure equitable distribution of credit to industries with a view to promote weaker sections of small industry, agricultural and new entrepreneurs. Certain norms are followed by the banks in granting working capital finance to the companies. Various study groups or committees have been formed for emphasizing these norms, which are the Hijia Study Group, Tandon Study Group, Kore Working Group, Marathe Committee, and Kannan Committee. Now, we will discuss objectives and recommendations of these committees one by one in detail. Let's first start with the Hijia Study Group. It was the first study group formed in the area of the bank financing. It was formed by the National Credit Council in 1968 under the chairmanship of Mr. V. T. Dahejia. In September 1969, this group observed certain loopholes in the system of bank financing. It was found that the amount of the short term credit was significantly higher as compared to the rise in the production levels, and it was being granted for very long period. Moreover, it also found that firms were using short term credit for expansion rather than the working capital, and they were taking credits from the more than one bank. The credit limit was decided by the borrower on the basis of security given, whereas ideally it should be decided in relation to the production levels of the firms. Bank credit was being highly inflated as it was used as the first source of finance. Thus, keeping in view these problems in the system, the main objective of the Hejia Studies Group was to reduce the problem of inflated and diverted bank credit. The main recommendations given by the Hejia Group were to put high charge on unutilized credit limit so as to induce companies to get their credit limit reduced to avoid charge. Stamp duty on the bills was exempted to promote their use for financing among firms. Third, firms were required to hold a minimum level of inventory for a given level of production so that the amount required as credit is reduced. To avoid the problem of credit diversion, firms were required to present their cash flow statements to show the trend of assets and liabilities. Fifth, firms were strictly asked to keep dealing with only one bank to reduce the problem of double or multi financing. And lastly, the time period for which the credit was being granted was fixed as maximum 60 days or 90 days in special cases.
It was also proposed by the Dahija study group to levy progressive commitment charge and interest on unutilized limits of credit to prevent firms from getting very high credit limits. To encourage the use of bills as a mode of credit, the stamp duty on bills is exempted. This step was taken as this mode of credit is more disciplined and with less chances of defaults from borrowers. To regulate the cash credit accounts, it was suggested that the firms should maintain the hardcore, that is, minimum level of inventory for maintaining given level of production and some amount of inventory for fluctuating part of account. For sound firms, the hardcore element is lesser as compared to those for non-sound firms. RBI also lays down industry-wise rules for minimum inventory levels. The Dahija working group pointed out certain weaknesses in the existing system of working capital finance. Banker does not decide how much he would lend, rather it is the borrower who decides how much he would like to borrow. Therefore, banker is not able to do credit planning. Bank borrowing is treated as the first source of working capital finance as compared to other sources available. The amount of credit given by the banks depends upon the amount of security provided by the borrower and not according to the level of operations of the borrower. There is a wrong notion that the security by itself ensures the safety of bank funds. As a matter of fact, security essentially lies in efficient follow-up of the industrial operations of the borrowers.
Tandon Study Group. It was formed by the Reserve Bank of India in July 1974 under the chairmanship of Mr. Prakash Tandon. This group was formed with the various objectives for regulating bank credit. These were to issue guidelines for banks for improving the safety of the credit system, suggest banks to get information from borrowers on production and credit forecasts, recommend the inventory norms with respect to their credit requirements, suggest modification in the existing system of financing working capital, suggest banks different ways of financing working capital, suggest on any other related aspect of working capital financing. Thus, on the basis of various objectives, this group came out with the three notions. The three notions were operating plan, production based financing, and partial bank financing. The first notion suggested that the borrower should present its operating plan of the coming year to the bank. This would show the likely demand, sales, inventory requirements, etc. The second notion said that the credit requirements by the firm should be related to the level of the production in the coming period rather than the securities. The third notion said that the banks should finance only a part of total working capital requirement and the firms should make a part of the contribution on their own as well. The last two notions were aiming at reducing the inflation in the bank credit.
Tandon Committee has made the following major recommendations. Inventory and receivable norms. Borrowers should maintain a reasonable level of current assets, particularly inventory and receivables, to ensure rational allocation of resources and to avoid unwanted financing of current assets. The banker should finance only the normal inventory based on production plan. Economic ordering levels and reasonable factor of safety. The banker should not finance any profit making or excessive inventory. Similarly, only those receivables should be financed by banks which are in tune with borrowers' firms and industry. The committee has made its recommendations to bring uniformity in banks' approach in calculating borrowers' working capital requirements. These norms have been specified to deal with the inflationary situations as well. These norms are not rigid. Some flexibility is allowed. In case of power cuts, strikes, breakdown of machinery, etc., deviation from such norms could be permitted, but for short period only. Lending norms. This recommendation is related to lending credit by commercial banks to borrowers. The current assets to be financed by banks must be reasonable and based on norms. A part of the current assets must be financed from long-term funds and the banker is required to finance only the remaining part.
Third, it was recommended that the banks should fix the maximum amount of working capital they would finance. It was proposed that the firms should be induced to finance some part of working capital themselves and take credit only for the remaining part. The group suggested three methods for calculating this limit. According to the first method, banks should finance only 75% of the net working capital and 25% should be put in by the firms. Second method suggested that the firms should contribute 25% of current assets through other long-term sources and 75% from the bank credit. Lastly, the third method said that the firms should finance all the hard core current assets and at least 25% of soft core current assets themselves. Fourth recommendation of the group was related to the style of the credit granted by the banks. It was recommended that the bank credit limit should be split into two parts, fixed and fluctuating. The firms are required to pay higher interest on the fluctuating part as the banks need to arrange funds on emergency. The last recommendation was that the appropriate information should be obtained from the borrowers from time to time to properly supervise and control the credit system in banks.
The report given by Tandon Committee Group has been widely debated and criticized. It is true that bankers found problems in implementing the recommendations of such committee, but this group has brought a change in the outlook and attitudes of the bankers and borrowers as well. The report has brought financial discipline for the lending by commercial banks.
Now we will come to the third group formed for regulating bank financing, that is, the Core Working Group. It was formed by the Reserve Bank of India in March 1979 under the chairmanship of Mr. K. B. Core. The main focus of this group was to strengthen and reinforce the credit management system through the recommendation of Tandon Study Group. This group also had various objectives and the basis of which recommendations were given. These were to check gaps between the credit limits and the utilization amount, to evolve flexible credit limits in relation to output, to improve management of funds by commercial banks, to have more disciplined credit facilities. After 5 months of its formation, the group came out with the various recommendations in its first report in August 1979. These were: first, it was proposed by the group to modify the lending system and use more of the bills and loans for financing than the cash credit. Second, it proposed to remove the system of bifurcated credit limits within overall limits and also the different rates of interest thereon. Third, it was seen that the production levels vary significantly in peak and non-peak levels. Thus, it was suggested to accordingly change the credit limits with changing production to reduce the amount of unutilized funds. This rule was applicable only for the firms with the working capital of more than 10 lakhs. The fourth suggestion related to reducing cash credit by encouraging bill financing. It was proposed to convert the loan against the debtors and 50% of cash credit to bill financing.
Ad hoc or temporary limits. In case borrower requires funds more than their credit limits, they should pay as penalty extra interest at least 2% to the banks except in banks where it is exempted by the RBI. Indicating quarterly credit requirements. Borrowers at the beginning of each quarter should indicate their quarterly requirements of the credit. They are allowed to draw their amount only within operation limits, and in case of irregularity, steps should be taken. Increasing borrowers' contribution for working capital. Borrowers are required to maintain a minimum current ratio of 1.33 is to 1 so that their own contribution towards working capital is increased and credit requirement goes down. For those who don't meet this ratio, the required credit given as working capital term loan on which they have to pay higher rate of interest so that they get induced to maintain current ratio. This rule applies for all borrowers having working capital of rupees 10 lakhs of more except SIC companies. Thus, there were some other recommendations made by this committee with approval of RBI which are as follows. Exemption of inventory norms and credit over and above the limit should be provided by the banks only in exceptional cases. Banks should follow the credit procedures very strictly at their level with respect to instructions issued by the RBI. Borrowers should provide all information timely for speedy processing of credit applications. It is proposed to remove stamp duty on bills to promote the use of bills of financing. It is proposed to set up autonomous financial institutions on the lines of discount houses in UK to encourage financing through bills. The credit limits should be properly assessed in relation to production at the industry level. A cell should be formed with chairman's office at the central office of each bank to properly follow the measures of credit control. The central office of a bank from time to time reviews the utilization of credit limit and inventory level of each branch. The communication channels and systems should be improved to increase the speed of collection of bills and checks by the bank. It is proposed to provide simple forms for speedy submission of returns. RBI should issue strict guidelines to ensure that the borrowers don't get involved in double or multi-financing. Large borrowers should provide data about their dues to small units in their quarterly reports. Thus, banks on this basis fix some portion of bills discounting only for the payment to small units.
Now we come to the Marathe Committee. It was formed by the Reserve Bank of India in 1983 under the supervision of Mr. S. S. Marathe. This committee was formed with the view to regulate the working of the Credit Authorization Scheme, so as to improve the credit lending system in the banks. The main objectives of this committee were to regulate and modify the CAS from time to time with the changing business conditions in the economy. The other objective was to examine the credit appraisal system used by the banks and guidelines followed for granting credit and making any changes if necessary. It also aimed at modifying the existing recommendations given by the RBI for granting credit and the system of granting and processing credit by the banks.
The following suggestions were made by the Marathe Committee. Committee made it clear that CAS follows same policies to grant credit to all sets of borrowers, whether large or small, although the security was comparatively stricter for borrowers who did not meet certain cut-off criteria. Its main purpose is to achieve equitable credit management. It was suggested to borrower firms to provide complete information for bank credit in time to reduce the time taken by banks and RBI in scrutinizing the authenticity of the borrower. Then, it should be a continuous process. To encourage banks and borrowers to comply with the credit requirements and improve the credit quality, it was suggested to provide incentives in terms of exemption of prior approval from RBI. It was suggested that banks can grant credit without prior approval of RBI if borrowers satisfy the following conditions: providing correct estimates of sales, current assets, current liabilities other than bank borrowings, and net working capital; proper classification of current assets and current liabilities with respect to RBI guidelines; maintaining minimum current ratio of 1.33:1; timely submitting quarterly operating statement of past 6 months and an undertaking for future as well; undertaking for submitting annual accounts regularly. These suggestions focus on reducing complexity of credit procedure. Thus, if banks are self-disciplined with respect to guidelines of Central Banking Authority, credit lending may improve significantly.
We finally come to the last committee formed for bank financing, the Kannan Committee. It was formed by the Indian Bank Association in 1996 under the chairmanship of Mr. K. Kannan. This committee was formed with the main objective of regulating and liberalizing banks with respect to working capital financing. Thus, to fulfill this objective, the committee gave various recommendations in its first report presented in 1997. In line with the main objective, the first recommendation was to liberalize banks in respect of working capital finance by taking various steps. It was suggested that the banks should have their own working capital finance rather than taking approval from RBI each time. It required banks to have their own system of risk analysis and risk forecasting. On the basis of this, they should take their own decisions as to whether to grant credit to the borrower or not. It was assumed that such a system should actually improve the speed and the efficiency of credit delivery system.
Apart from making banks self-dependent, certain other measures were also taken to liberalize financing by the banks. These recommendations mainly aimed at removing the restrictions earlier imposed by the Tandon Committee and reinforced by the Core Committee. It was suggested that the new system should be improved. The features of the new system are: first, banks should use the method of desirable bank finance in place of liquidity level lending. In the new system, banks decide the credit limit on the basis of turnover of the borrower firm up to a credit limit of 2 crores. The second feature is the use of line of credit system to fix sublimits of credit within overall limit on the basis of funded and non-funded working capital requirements of the firm. Third, borrower firms are no more required to pay any penalty or charge on the unutilized credit amount. However, if the unutilized amount is more than 80%, then the credit limit should be reduced. Lastly, in case firms require credit beyond credit limits decided by the line of credit system, they should pay higher rate of interest as an extra charge. Thus, the main focus of this committee was to liberalize the bank credit system and evolve a new improved system of credit lending by the banks.
In this module, we have learned about the various committee reports issued for the bank finance and their recommendations. These are the Dahejia Study Group 1969, the Tandon Study Group 1975, the Core Working Group 1979, the Marathe Committee 1983, the Kannan Committee 1997.
Let us now recapitulate what we have learnt in this module. Reserve Bank of India, known as RBI, regulates banks with respect to short-term bank credit to ensure equitable distribution of credit to industries with a view to promote weaker sections of small industry, agricultural and new entrepreneurs. Certain norms have been followed by the banks in granting working capital finance to companies. Various study groups or committees have been formulated for granting of credit by the banks. Each company's working capital is determined as per the norms. These norms are based on the recommendations of Tandon Committee, later on Core Committee and then Kannan Committee. Limit for maximum permissible bank finance was given by Tandon Committee.